small piece of work we did now more than a couple of years ago, okay? And it's a UK company, and if you really were interested, you could figure out who it was. They are a marketplace for tradespeople in the UK. One of you probably already knows who it is. And anyway, this is long, this data is way out of date. But this is a company who was doing like 15 million euros of revenue, so I chose it because it's a reasonable size. And they were aiming to get a larger round raised or an exit at somewhere like 50 to 100 million euros. So I thought reasonable here. And so this is what they presented to us. They said, this is our kind of big slide. Yep. We kind of, to frame the opportunity. Now, of course, the thing is the gross, we do 2 billion a year of gross transaction value. We already have 60,000 people. Look at the scale of our network, and we do a million plus jobs. So we're already at significant scale. Here was the problem. The problem was there were 15 million of revenue. The risk you have is once you go down that road, the immediate first impression somebody has is, oh, it should be a much bigger company. What's wrong with the company? Why isn't it 100 million of revenue? So I don't get it. So that doesn't, you know, it's your cost of puffery, if you know what I mean. Like you big yourself up, and it's like, oh, why aren't you a 100 million company already? And the answer is, well, let me have to explain to you that there's some problems in the market that we also have to solve. Yeah, this is the curse of beating your chest. Now, this is what they presented to investors. So, so we spent a day with them, and then we said, well, let's be a little bit more humble, but also go to the level to break it down. So we go to the next slide. So what we did at the end of the day, this is literally a day's worth, right, was we said, we're going to look at value and growth drivers. We're not looking at how big you are already. They thought, in their mind, they're going to get a premium for market leadership, yeah, and having such a big footprint. They wanted footprint value, if you will. What we said, Series C investors, they don't care about footprint value. It doesn't matter. If it's something very hard to do, get credit for what's hard to do. But claiming footprint value is irrelevant. There's a big market, home improvement, it's 43 billion. Of course, that has nothing to do with anybody, and it's a meaningless number, but it's a very big number, which means that, you know, 2 billion ain't that big a number. Like, there's a lot more to play for. Yeah, which they were initially resistant to because it's like, well, it makes us seem like we have a very small market share. The answer is that's the point. Then the 2 billion you recognize. Then we said, well, actually, at the moment, there are two breaks. So what we said is, okay, fine, you know, and then you can increase the percent of jobs won from this, and then increase the percent of jobs captured, et cetera. So you can end up on the other side of getting to a ridiculously high number, meaning, you know, but the point is not, oh, we're going to get to 300 of revenue. This was the next question. Well, we're going to go from 14 to 300 then. And the answer is no. No, you're not going to present a model. This is the next point. You're not going to present a model that goes 14, 42, 91, but which most companies do. Why? Because the investor's going to take that, rip it up, and never look at it again. Yeah? So what we said is, actually, you're talking about this 300 million of value that's captured potentially, or potentially able to be captured by you. Okay? That's not the model, but that's the opportunity you're playing for. And the real question is then, how much of that are we able to capture during the investment time frame of the new investor coming in? Now the equity story and the positioning is, what are the levers we're going to pull in order to be able to do that? And then, which we didn't really do, which is why I can use the slide, is all the way down the detail of exactly how you're going to be able to execute this and that. And had one of the most experienced CFOs I've met for a company that size. Both she and he, frankly, well, they had run much larger companies. So this is not people who were doing it the first time out. So we were surprised. And the point is not because they're somehow deficient. The point is you get into this sort of tunnel thinking. That's the point. So this is an example of exactly what can happen when you get into that by people more experienced than most of us here in the room. So if it can happen to them, it must be happening to some of you. There's a lot. I mean, I have like probably 400 of these examples that, you know, sitting around. But I mean, of course, many of them we can't use. But just hopefully, it's helpful just to be able to think about it. Credibility. It becomes hugely important because you need to anchor to things that have been executed, not anchored opportunity. So credibility. And so I guess I'll just talk about the model as well. The companies build models. What is the single biggest problem? The investor rips it up. Then we get into a discussion, well, how conservative should I be? If I'm too conservative, I'm not going to get paid for it. If I'm too aggressive, I'm not going to, So like, great, Victor, so what do I do? Right? And the answer is, what we normally will try and do is build it up. What's the single biggest failing of model? Two biggest failings. One is the hockey stick is not believable. The second is that the assumptions on which they're built are oversimplified. Very often it's hire salespeople, 3-month delay, they become productive, we generate revenue. Okay? Probably more than half models are built like that. Well, there's other, like in this example, many other factors that can come into play. And so, you can look at 2 or 3 different ways of building up revenue depending on certain things. You can box them, meaning cross-check them. And also, you can also taper your forecast down a bit in order to make it more credible. We normally will say probably pitch it 20% above, maybe 10 to 20% above what you think you'll do. Like really think you'll do, not if. 50% gets ripped up. If you're not 20% more, you're not probably being aggressive enough. Now, again, there's a whole day's worth on that, but you get the idea. We're still okay for time, so that's good. Is this helpful? Okay, all right, good. Now, this next one is completely different, which is brand value. Yeah, if we go to the next, right, sorry, you don't have to look at this big thing here, don't worry about it, right? But it's just to show you. So investors are increasingly paying attention to brand value. Now, before any of you look at too much of the detail here, I'm redefining brand value, right? Brand value comes from a lot of different sources, not Net Promoter Score. And it's not, which words people use to search for you on Google. It's not that, right? It's a whole set of external data points that people get that formulate in their mind the value of what it is you build. And therefore, how likely you are to sustain that impression with people who matter, which are your customers, at the end of the day. Sometimes it can be expressed in NPS, but NPS is notoriously unreliable. So it's only one metric. And it started coming in 2016. So this is, this backstory here is, there's somebody who hacked into Colin Powell, the former Secretary of State, hacked into his emails, extracted all of his emails. He happened to be on the board of Salesforce. Yeah? And so they got, as part of the emails, a presentation that was done internally for the board of Salesforce on companies they could acquire, which was put out on the web, so that's why I can use it. So I went back searching for what was the first instance we could find of when external brand validation started coming in, and this is one of the earlier ones. So in 2016, they already were looking at large acquisition targets, and one of them was a CEO rating on Glassdoor, and would recommend on Glassdoor. This is for Adobe. I mean, so, okay, fine. They're looking at market cap and, of course, these other things, but they started looking at these metrics. So now we fast forward to 2019. What do we routinely check? And I will say we is a subset of what an investor would do. Right? We look at NPS, but how it's calculated just as much. I mean, there's different, NPS is not NPS is not NPS. It could be NPS for customer experience. It could be NPS for, there are different flavors of it as well as an aggregated NPS. And NPSs, depending on different geographies, may or may not be reliable or able to be easily calculated. So we scour for competitor evaluations, product evaluations, what people are saying about alternative products, whether they're digital or they're physical. We look everywhere for negative reviews. Everything we can find that's negative about a client when we first start out. And you may wonder, it's due diligence means something very different today. So, but also part of it is we're trying to front run everything an investor's going to do before they do it. So, and by the way, we found, Glassdoor is notoriously unreliable. TripAdvisor too, if anybody's in that space, is like, they basically put a gun to your head and tell you, well, why don't you pay for TripAdvisor in order to, have us be friends, right? Gartner, by the way, is a high-class suit and tie version of the same thing. Which means that the Magic Quadrant for Gartner, depending who you talk to, some people rely on it, some people don't rely on it. But it's ransom money. For a lot of companies, you've got to pay it. So, because people look at it. But we also look for in-market reports by people, tiny consultancies and things like that, right? Who senior has left the company via LinkedIn? And sometimes that maps onto everybody's left, sometimes it doesn't. But we try and front run it because we know every investor gets serious is going to scour LinkedIn for that. What people are saying about companies, the hearsay, Paga. I mean, like, oh, Paga's terrible because of this, right? Or, Cars 45 is terrible because of that. Whatever it is that anybody's saying, because these things just get out and they become somehow conventional wisdom. And especially people a little further afield, it's like, oh yeah, a guy I know, I emailed him and he told me blank. And they say yes or no to a meeting. So it's the VC industry is one of the most gossip-driven industries on the planet. For a group of people who are supposed to make reasoned decisions with one half of their brain, they can't help themselves engaging the other half of their brain. And which is, oh, I heard that he was having problems. No idea. So, which by the way, is very useful because you can't change, how do you change it? You change it by making proactive, sustained effort on things like corporate marketing in order to neutralize it. Get the word out, do releases, et cetera, everybody in this room. But the point is the preconceived notions in investors' minds before you come to the table. So doing that work ahead of time so that you have a clear idea what is coming down the pipe. Because what is the biggest problem with initially engaging investors? The false positive. I meet, I love it, and then nothing happens. So, because they checked with somebody or whatever. So you just need to be able to front run those. It's raising a larger amount of money is about objection management at the end of the day. Objection management means you need to know what the objections are before you can manage them. And the second is you need to be ahead of them. So it's a schizophrenic job that we do because we become huge advocates of the companies we work with, but we have to basically look at all of the trash they put out. But that's what my point. Sorry. Yeah.
So how big is it if like a senior person left? So for example, we got rid of somebody and then our revenue jumped by 200%.
Right.
But that's not going to be the story that's on LinkedIn, right?
Right, of course.
So how would you suggest, like mitigating decisions that you've had to make to know that you're going to increase the value of the company, but yet it looks bad?
Well, so I can only give you a quick kind of view. Putting it in a bigger context, number one. This person, yeah, sure, this person left, but what we're trying to do is to go from this to this, right? We've got this and this and this. We've got this open area. Oh, but this person happened to leave. All of these things we're doing means the company grew 200%. It's you depersonalize it, right? Because they have no choice but to personalize it, which is if she hadn't let me go, this would have been whatever it was. So because you have the option to depersonalize it, look, again, investors are not dumb, right? They're gonna, people leave all the time. But it's, I was just helping an investor with another company where the company's doing pretty well, but 2 of the 3 founders had, I don't know what the argument was, but they both quit. So we went from 3 founders to 1. They could both quit, which is pretty surprising. Like very, very quickly, and the company's going like this. And so like the investors went, well, what do we do? Because this is going to come out. Well, the answer, in that case, just to counteract what I said earlier, I said, look, do not put it in context. I do not say, oh, we had a managed plan to, professionalize management, because that's bullshit. If you lose 2, 3 out of 3 within a 3-month period, you say, you know what? Amazingly enough, the company's resilient enough that they both left, and we're still growing. Imagine what we could do. And by the way, they have a new CEO. She is from the industry. We took the opportunity to actually be able to bring somebody because they had a vacant seat. You know, we wouldn't have otherwise had one. And the company's continuing to grow. If it's growing 30%, even despite, imagine what we could do without it. Not a perfect answer. The other answer is don't fundraise soon. So make it last year's thing, not this year's thing. That's a tactical point. But yeah, so you have to be careful about sugarcoating. But so sometimes the context thing is fine. Sometimes, again, if you start with the assumption, like I always do, that the people that we are presenting to are smarter, that's just a good place to start. And then you avoid doing stuff.
They're really
Huh?
smart. They're really smart.
About your industry.
Are they? You said? Are they?
Are they really smart? Yeah.
Oh, no. I'm not laughing because it is funny. By and large, no. Smart, let's break down smart. Smart is trained to be analytical, of course. That I would say at least as much as you think they are, right? Having the ability to develop real insights, make connections about the company, et cetera. I think a lot of times they're hidebound by their training and, you know, the focus in terms of looking at it. Having, which is not really smart, but having a basic experience, understanding, know-how to be able to, yeah, I get what they're really saying. They need, let's put it this way, the way I would answer it, so smart is probably an unfair question. I'm answering with a different word there, but probably they need more education than they would say that they do. And one of the challenges is being able to rapidly deliver education in a way that, you know, yeah, I get it, but like, because they probably need more, and they're not going to admit it. And especially when, you know, you're crossing over to the continent here, where, I mean, what's the saying? Like, you know, people who don't know anything about Nigeria get initially excited, then they want to learn the reality, right? And then maybe they get excited after that, but they have to go through the phases. So, and in a way, what you also don't want is thrill somebody who gets all excited about Nigeria. I'm just using this country as an example. You know, say, oh, we should do a deal. Oh my God, all this other stuff. And then you never get over that. So in a way, maybe you front run it by saying, here are the complexities in the market. But by the way, nobody else is doing it this way. We've solved it and done something hard. Here is how you do it in a place like Nigeria. We've had to do it, and we've come out the other side, for example. And therefore, you package education in the context of achievement. But you probably, overall, you probably need to over-educate, I would say, even for people who know. Because also, even investors who are quite experienced in the continent often have less experience in tech. Rare, I'm trying to think of the volume of investors who would typically do seed rounds, or C and D rounds, who do only tech on the continent. I can't think of one. Maybe there is one. So, you know, they don't exist. Now, so I'm not suggesting you can get away with just that, but I can only give you a high-level answer to the question. The other thing is there are also, the further you go west, the more stringent investors are going to be about, you know, doing one thing for one market, et cetera, and scaling it. The less relevant it is for Africa, because it's just, you can't make that. They want Dropbox.
Yeah.
They don't, you know, you're not Dropbox, and none of you. So you're never going to be Dropbox, because you can't win in Africa being Dropbox. PayPal, for example, is a good example, right? PayPal is almost nowhere in Africa. It's like not that easy. So even Facebook isn't really anywhere. So, you know, it's, and that's, so it also depends on the kind of investors you want to go for, because the further west, the harder it is. Therefore, by the way, generally speaking, I would say the yield we get from East Coast is much greater than the yield we get from West. With a few, Iconic being one that's an exception, and there's a few others that are on the West Coast that really get it, but by and large. And Rise, you could argue, is West Coast if you wanted to. So yeah, there's a core group, but the up and down Sand Hill Road, I'm going to make a flippant comment, which is that here, Kenya has an advantage over Nigeria, because they can invest in a Kenyan company and go to on safari once a year, and they don't. And that's true. Tell me I'm wrong. It's true.
I was in the office with a partner at Sequoia Capital, and he's like, I don't know anything about Nigeria, but I did go on safari.
Yeah, exactly.
And I was like, oh my gosh,
Yeah,
like
so.
we're so far.
Yeah, exactly.
And
Yeah. It used to be. I don't want to take up time making too many jokes. Can't resist one, which is that it used to be like 20 years ago in Europe, people would invest in a UK company, go to Wimbledon. The same idea. So no real difference. It's just Nigeria doesn't have that kind of selling point, really.
I was just saying, I had a couple of investors and I'm trying to convince to come to Nigeria for something. And I said, let's try and find it. And the response was, oh, great, we'll time it with our trip to Kenya and we'll do that safari. And I'm like,
Ooh, yeah, they don't realize that it's kind of like going from New York to California. Like yeah, they don't realize, yeah, it's not like going to Rwanda, just dropping, yeah, it's hours in the air. Yeah, once they look at all of it, they then back off. So, look, we get it. I mean, I get it, and we understand the translation issues, but it also depends. Some people are just not going to convince. So, yeah. So the first thing about business model was looking at. Now let's look at it in terms of financing, right? So this is typically how companies will look at, how we present our business model. And you don't have to look at every word. Maybe you can't say everything, but what's their revenue growth and paid subscriber. This is from a former client of ours. So new bookings and average ACV, booking size, distribution. And then you've got these unit economics, which are one of my favorite things. You've got lifetime value. You've got number of quarters to cover customer acquisition cost. Different way of showing LTV to CAC ratio. By the way, there's no, some of you may not know what lifetime value and customer acquisition cost is. Should I explain it? Anybody's benefit? I mean, yeah, should I, you two? Okay, fine, all right. Please tell me, just explain it, I'll do 30 seconds on it. But, okay, net annual, when they say portfolio, it was their portfolio of SME customers growth, and then the number of multi-year deals, because they're changing the typical sort of stuff that you would expect to present. And there's nothing wrong with that. Now, here's the problems. Okay. And again, this is a whole workshop, which is what investors require, which is the previous slide. They want to see all the numbers. Metrics are part science, part art. So let's go through each of them. Okay, so lifetime value. Do you include upsell? And at what rate of upsell? And if you've got multiple products, what's the upsell rate forecast for each of those? Because lifetime value is not just what you sold them that they're going to keep buying, but what you're going to sell them that they're going to keep buying. And what is your implied assumption? That changes LTV dramatically. Depending on what you can sell an investor on, can totally, and what are you trying to do? You're trying to increase the numerator and reduce the denominator, so that your LTV to CAC ratio goes like this. If it goes like this, everybody says, the unit economics, there's an engine here. It's I just add water, sorry for the mixed metaphor, just add gasoline, and it'll, right? All you want to do is say the engine is idling. So, number of years in lifetime, one of my favorite ones, right? There's no right answer. Yeah, what you normally would do is say, okay, well, we take customers and then we look at churn rates, and that's how long they're going to stay on. Except churn is a dynamic thing. It can change. Do you do average churn, median churn, churn over different types of customers, over what period of time? How do you look at it? How do you measure it? Because then the question is, well, what churn number do you apply? And once you look at lifetime years and upsell, you can get an LTV that is here or here. Now, we're going to talk about credibility filter here, but yeah, and I could probably argue for, well, certainly between here and here. Now, customer acquisition cost, the denominator. So investors always say, well, we want to look at fully loaded. Fully loaded is a very dangerous term. It's kind of like a fully loaded gun. It's like a very dangerous term. And I'll give you a very specific example of where it failed. This was on this large fundraise, right? $75 million, so not small. So what are the adjustments you need to make to sales and marketing costs that don't contribute to new sales. So in this case, the company had customer success costs in sales and marketing. What is customer success? We had 1 week of back and forth argument with an investor you would all know about what is customer success and should it or should it not be included. And the other investor at the table didn't care. Two funds, both billion plus, both with the smartest people you ever met. One cared for a week, one couldn't care less. So that tells you the science is less than you think. So customer success meaning that, once of course we get a customer, we invest. The problem was they were saying, well, actually customer success is part of upsell. I say, no, it's not. It's just trying to make sure customers are successful. Yeah, of course, their job is partly upsell. Do you want us to go through and micro-calculate what we think the proportion of time is that they're doing upsell versus just looking after customers? Do you even care? One didn't, one did. We had to do that exercise for the other one. Right? So, and by the way, the numbers look completely different when you take out customer success, because while they were growing more slowly, they had invested a lot in terms of looking after customers. Their point was, we're going to have a higher value customer base by doing this, but don't penalize us for doing it. And then over what period is customer acquisition cost calculated? Now, you're going to think this is stupid. Like, of course, the thing is you look at the quarter before and you apply it to, the customers you got and say, well, that is it. No. Sometimes you have to look at the half year before. Sometimes it's the month before. What's the natural rhythm of the business? And we've had companies, very large companies, miscalculate this. Now, what is the penalty here? The penalty is, normally you need to have an LTV to CAC ratio that's more 3 to 4. If you can get 6, 7, 8, great. 10, nobody believes. So there's a credibility range. But the valuation difference between 3 to 4 and 5 to 6 is like this. Same company. So, this is where the battle's won or lost. I mean, it's great to talk about fluff and positioning, but this is where it's won or lost. Getting it to a point, now I'm not saying you can take 3x and turn it to 6x, but getting 4.2 and turning it into 5.7 can pro rata increase the valuation. Literally pro rata. So the amount of time we spend up front digging into it, what will sell, how can we argue it, front-running issues, and what will investors accept? Again, and of course, the guide normally is if you're more than probably 4 or so, it's worth putting more money into sales and marketing. If it's less than 4, it's not. Of course, if you're raising a C round, you're raising money to do sales and marketing. Therefore, they're like, are you going to put my money to good use or not? So what you're basically saying is yes, or maybe. That's actually what all of these calculations are saying. They're telling a story that is far more powerful and far more valuable than any words you will use.
Sorry, what's the customer success cost? What does that mean?
Well, that was a point. The point was there was a team of people in sales and marketing. And the problem was the company put it in the sales and marketing area physically and sales and marketing costs. And this was a group of people whose main job was to call up customers, make sure that they were using the product successfully, help them, talk to them about how else they could use it, and basically see if they can get embedded, embed the product. Right? Then of course, part of what they do is upsell because you're on the phone. That you can't really say they're responsible for upsell because it's an upsell team, which is in sales and marketing. It's just
If it's upsell, then it's part of the acquisition, right? But if you're just
correct, right. So what the investor said, no, it's part of customer acquisition because they're on the phone talking, they're teeing up upsell, okay? We said, no, there's an upsell team over here, you can go see them, right? They don't really do that. They said, no, they do that. We said, okay, fine. If we play to a draw, maybe some of their time.
like 50% or something.
Well, then the problem is it's a big team, customer success team. So that throwaway comment was where we started, and then we realized, oh shit, sorry, pardon my French. It's like if it's 10% versus 60%, that actually makes a difference. Now, okay, the number the LTV to CAC ratio is not going to go from 4 to 8 as a result. But, like I said, first of all, it has to get over 4. And second is proportionately, it's that proportion to valuation. So like we're playing for a lot of money.
So you just like record their conversations and you just see like what percentage of the time they're upselling.
It was just, and there was only one investor.
Yeah.
Unfortunately, they were the most serious investor. The others didn't care. So we really had, bad luck from that point of view. But I'm just giving you an example. There's lots of other examples we could talk about. But this is just one example of where these kinds of things, and by the way, the company didn't even think about this. Just put it in sales and marketing. Why are you going to call out another cost? I mean, it was just packaging. That's all it was. Yeah? And so this is just one of those, be really careful about this stuff. So again, this is why, you asked a question about positioning. Like, yes, that's important, but most of the time, this is why 95% of what people talk about is bullshit, is because they say, write pretty slides. This is where you win or lose. Sales efficiency is the other one. Oh my God. Okay. Is sales efficiency, right, which is how efficient, you've got a sales team and then they produce new customers. So what's the degree of effectiveness in terms of the sales cost versus new customer bookings? We have some of the same issues. Is upsell included? Because, are they selling upsell or are they selling only new bookings? What bookings should be included or not included? Should we include certain types of revenue or not other types of revenue? So what maps to what? And then the other, so for example, it's important for companies who have a very high net retention rate but may have slowed down their net new sales. They say, well, actually, if we have a high retention rate, then, we're an increasing up, right? So you should give us credit. The problem, and there is one fund that everybody will know, who I was astonished, insisted on calculating it wrong. Absolutely insisted on calculating it wrong. Until literally, we wrote them a paper, whatever, and they just came back and said, anyway, but people, this is a $10 billion fund. So this stuff is an art, not a science. And by the way, the other thing is, do you do it 1 quarter back? Do you do it half a year back? What's the exact amount of time you do it? By the way, we found like if you do it a quarter versus 4 months versus 6 months for certain companies, it changes the number. And the point is not to try and just play with numbers. It's like, look, basically the argument was that sales effort over a 6-month period is required in order to get new bookings. Or what we said is actually you should look at first half of the year sales cost, second half of the year new bookings, not quarter to quarter. Again, some investors that are household names insisted on calculating it 1 quarter back, 1 quarter forward, only new bookings. But that's not how the company operates. They don't run that way. Or, yeah. For other companies, for one company we're working with, it's a 43-day sales cycle. 1 quarter back, 1 quarter forward almost isn't the right way of doing it. Yeah. So it's something where you just need to be extra careful. The final thing is churn. If this is too detailed, or I hope it's helpful. This is kind of like really getting in the weeds, but if this stuff didn't generate 20, 30% more price per share, I wouldn't be talking about it. Churn. Logo churn, meaning number of customers, versus value churn, which can paint a completely different picture. And some investors are like, well, I really only care about value churn. Others are, I need to look at both. Others are really logos are important. And again, the churn number is, and by the way, you may have also a situation where people, quote, churn, but are going to come back. Or churn that matters. So you may have a customer base, distribution base, or whatever, where 50% of it makes no difference. You don't care. You shouldn't even measure churn on it. You only measure churn on those you really care about. And so what you're presenting is the churn that matters, not overall churn. People find this when they have, for example, SMEs or very small customers that come in and out, and the churn number is like 28%, and people get scared off. But the point is it may be 11% of the revenue. So who cares? And this is forest for the trees, but the moment an investor calculates it, the moment it's like, oh my God, that doesn't work for me. So it's an impression point. The final thing is capital efficiency, which is, it's often vague, but basically it's ARR divided by capital spent. So a good number is 0.8, meaning I raise $8 million in order to give you, Mr. Investor, $10 million more of repeatable recurring revenue. A very good number is 0.5. So over 1 is bad. People are basically looking in around the 0.8 range. And that's, again, one of those things like the rule of 40, like yes or no. Let's go to the next.
So for B2C customer businesses, what's the most aggressive active customer definition?
Oh, God. Oh, yeah. Can we take that offline? That's okay. We have a very small number of slides to go through, and then we're done. So let's go through the next one. Yeah. So this covers sales efficiency, which is the dark art, right? Let's say you spend $1 million on sales. If your revenue increases by 25 cents in the next quarter, you'd have a magic number of, which annualizes to $1. You'd have a magic number of 1. So I hope that's clear. And then the sales magic numbers, if it's less than 0.5, you're not ready to invest. If it's less than 0.75, evaluate. Greater than 0.75, invest. This is wrong. This is an extract from an article. It needs to be a little higher than this. I mean, I don't know why but this is not current practice. I can't remember where I got this from. I don't want to blame the author, but it needs to probably be about 0.8, 0.7 to 0.8 minimum before people really pay attention. This minus 0.75 evaluate. Evaluate means no. So, and 0.5, they will never even look at it. It's not like not ready to invest in S&M, but I'll put money in. Like I won't even touch it. One thing to be aware of. Now we're done with metrics, right? The other thing is the paper trail you leave. One of my big things is board packs. They can be landmines that explode. And the reason is, I mean, it sounds silly, right? You do board packs for investors, but the thing is that once you do the story, presentation, et cetera, they get into due diligence. Board packs are their next opportunity to see a presentation, right? Except this is internal now from the company and really says the real story. And so they say we want 2 years of board packs, which normally we can negotiate down to 1, maybe. Well, not normally, maybe. And we want to see them all. Yep. And then, so what we've done in practice is look at board packs early on. And guess what we find? Horror stories. Right? This is a disaster. This is on fire. This is worrying. But oh my God, this didn't work and this happened. I mean, just horror. If you read the board packs only, you would assume the company was going to fail tomorrow. And of course, companies say, hey, look, we want to have good discussions with our investors, right? We're not interested in having stupid discussions with them. So of course, we're going to have very high quality board packs. Almost always there's too much information. So one of the things we suggest to companies as part of preparation is thin down the board packs, do it in a side letter. If you do a side letter, it doesn't have to be disclosed. Board packs, nobody ever, well, sometimes they ask for all board communication. Normally, you can get rid of the board communication because normally they say, look, here's all the board packs. If they're complete enough, you've played a bit of a game, and you've had reasonably good, honest board packs, but some of the stuff that's really negative, put it in a side letter. And nobody sees it. And it passes diligence. What do you track? So KPIs, as I said, we've just gone through some of them are works of art based on science. So the thing is, you can't really, it's much harder for us to say, oh, let's present LTV to CAC this way, and then they look at all the board packs and they're done a different way. And like, well, okay, who's lying here? So it's worth aligning. How do you track it? Measurement periods, specific adjustments, things like that. Basically building a paper trail. Now, sometimes if we're getting involved in, it's a short time frame, we can already suggest certain changes that can be done that are evolutionary, but it takes a year to do fundamental change. And then what commentary? So, and this is another thing, like board packs, sometimes like the things written down in the board packs are worse than what's actually presented. Yeah, and the words are the ones that are problematic. The commentary should be ideally more focused on some upside metrics. Again, look, I'm very, very conscious that board packs are meant to engender a discussion, not a selling document. Just please understand they're also selling documents. I usually didn't intend them to be that way. Okay, then shareholder financing, we do this quickly. This is something very near and dear to your heart. Dilution, right? Which everybody worries about. So there's a first law of financing, which is that only thing to worry about is price per share without structure. Price per share, valuation of what's the enterprise value, the company value, the whatever. If it's a simple structure, the only thing you care about is price per share and what happens to price per share. It's a single source of truth. So, and also in terms of doing term sheets and things like that, I can't tell you how many times we look at a term sheet and nobody's ever bothered to calculate the price per share. Guaranteed potential for dispute. Dilution, I put in irrelevant, and yeah, I can say that because I don't own a big chunk of a business. I founded, well, that is, raising money. But it's usually not worth trading it for more structure. And what we find is somebody says, I want 100 million valuation. And if you give me a participating preferred, blah, 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 that's fine. I want 100 million valuation. The answer is that oftentimes it's not worth it. But it does matter. If founders drop below some number, dilution really does matter, because at some point, if they're 10% of the company, you rely on them to run the company, it doesn't really work anymore. Or some number like that. Certainly if they're way below 10, they're more managers than founders at some point. So one does have to be careful. But generally speaking, there's much more focus on dilution and much less focus on price per share. But structure really matters. So look at this table. By the way, the recommendation we always make is for every term sheet, if I just finish it, for every term sheet, the other thing that oftentimes never shows up in a term sheet is a proceeds table. Like, what do I get and what do you get at different exit prices? Exactly. We'll calculate it to the penny, because price per share and a proceeds table are the two sources of truth. Company value and what adjustments are made is secondary. So, and very often we get involved in helping people when they already have a term sheet and are looking to broaden it out, and I've never seen a proceeds table in 25 years. I mean, we do one every single time. So, so then so this is exit value. So if you raise 30%, assuming the 30% founder stake, 30 million invested capital, I think it's a 50 million pre-money, you probably can work out the numbers. Basically, the same thing at different exit values. What are the founder proceeds with different structures? So same valuation, different structures. So this is just the effect of structure. And the effect of structure, yeah, sure, it doesn't matter when you're over here. What are the number of $300 million technology-enabled company exits in Africa in the last 3 years? It matters. It matters because the vast majority of companies will end up further to the left than they ideally envisioned to be, which is fine as long as you're not stuck with something extremely expensive. So this is kind of where I put it at 200 and I put it at 50, which is the worst case, and you can see it really does start to make a difference. So again, I'm not going to go. 1x liquidation preference is just a straight, preferred structure. 1x participating preference is where the investor puts in 20 million, gets 20 million, and then their percentage. And then this is that with an 8% dividend, which doesn't sound like a lot, except it starts to cost money. Right? And the effect is compounded by definition the longer the holding period. So, and of course, these things are forever once they're in. So, there's a whole lot. I mean, we do more and more cap table resets when we do Series C, meaning that the existing investment instruments have to change in order to accommodate a new investor. Because a company says, you know what, I'm going to be raising, say, $30 million in a Series C. I wanted a very flat structure because I don't want anything. by the way, the previous investors have got a participating preferred, maybe with a dividend, and then the new investor says, I am not doing that. I'm not interested in them getting, big chunks of money out or getting a dividend out, and I'm not. So you have to flatten those instruments to a liquidation pref in order for me to put money in. Then the investor's like, well, we just, what do we get? And that's a problem we're solving for companies. Literally, one of the two deals I mentioned. Yeah, one of them, not the other. We're doing that right now. So, and it's not straightforward. But you can't afford to raise $50 million down here. It's very expensive. But you can if you're raising 5. The problem is the 5 travels all the way to Series C, and then you got to fix it. So people like us have to fix it. So I'm trying to say don't do it in the first place if you avoid it, so we don't have to fix it. If we have to fix it, we will, but a little bit more painful. A couple of final points, and we are out of time. So there's a few Africa-specific issues. I'm sure you're aware of it, so I just highlight them. This inefficiency of early capital, right? You have to, waste money doing stuff. Premium for asset light, yeah, but it's in the category of easy to say, hard to do. Some African businesses can be asset light, but there are only some, and most are much more asset intensive than their equivalents elsewhere, and it's just a fact. So I put this here because people mention it all the time, but it's basically yes to everything everywhere, but so what? Going cross-border, this is a really interesting one. It's like, what is enough? So the question is, if I put a flag somewhere in Ghana, and have a Ghana operation, like, is that okay? Do I get more money? Or do I actually have to operate in Ghana? And we're operating in Ghana. sorry. I'm sorry, I didn't mean, I guess it is a joke. So yeah, if I have to operate in Ghana, then that means, what does operate mean? Basically, can I graduate? The underlying question is, can I graduate to a higher valuation by doing a certain number of marginal things that will point people in the right direction, but I don't have to distract everything else I'm doing in order to get it, is the basic question. And there's no hugely right answer, but it's definitely there. Some people, investors want to invest in platform companies, which they view as international. The other thing to think about is working backwards from an exit. Buyers ultimately probably want a regional play, not take Nigeria risk, or multi-country play for sure, not take unique risk, and they operate elsewhere. And so, but it partly points to the fact that we're closer to an exit, and all those things. This is not something I'm going to talk about with a group because it's company specific, but there's going cross-border ain't that easy. The value, cost, complexity we talked about before. Solving the problem of bench weakness. So the problem tends to be that your second and third line management, just the pool of people is less at this stage of the market's development. It's the exact same in Europe 25 years ago, 20 years ago. Exact same. Then conditions are entirely different here and also in East Africa. Early. But the problem, so at a very early stage in the company's development, kind of creating a mini Andela internally to be able to train people so you can get second line management. The risk is, of course, they leave. Safaricom offers them a lot of money, or Access Bank offers them a lot of money. It happens, right? But at least that's a way to inoculate against the problem. And then the final thing is, when we're talking about exit, is a requirement for companies to move earlier to EBITDA because there's a lot of African private equity money that wants EBITDA of 3 to 5 to 10 million, and you're back solving to get them interested. And so do you need to move to EBITDA earlier and maybe have a lower growth profile in order to qualify for those buyers, even though they're not 20 times EBITDA buyers? So, you're solving for something that is not ideal. But it does expand the potential buyer group beyond Shell or PayPal or whatever. And then, you have a relatively small number of potential buyers or strategic. So, no right answer to it, but it's something that's worth thinking about in the context already of building a model for Series C. Whether you put it in or not, it's worth thinking about. Final thing, internal resources to do around. I would say on average, even with the best companies, there's usually one point of failure in a 3-person internal team. Somebody, whether they're senior or junior, but it's, the mistake I think CEOs make is they assume, oh, we'll get a team of 3 people on it, one of them's pretty good and has some experience, The problem is not that person, it's the other person who's going to fail. And failure means that something gets sent to an investor you never want sent to an investor because it's wrongly presented because they, right? So it's an easy thing to say. It's hard. We'd rather have fewer people than more people internally, perversely. Model that's credible. We talked about it before. Help that really helps. That's what we try to do. But also, I'd say lawyers are a big, big, big problem sometimes. The gradient is enormous, enormous. You know, and people who have the most experience, tech-enabled businesses, it just moves a little bit. You know, it's just not the same. So we have one of the two that's hopefully closing in September. We have a big problem. And it should not have closed in September. It should have closed earlier. So, I mean, that kind of thing. Rethink everybody who helps. When you get to Series C. Probably not when you get to B. You can probably live with it. But you may want to build a relationship in B that travels. That's it. So,
Thank you.
I hope that's helpful. I think everybody's fired a question or two, but anybody, any other questions, disagreements? I've made certain things black or white that are not. Like somebody who might have touched the site, you know. Does touching the site count as a user? Yeah. Well, yeah, it depends if you're public or private.
What do you, I mean, so if you just take typical transaction business, whether it's e-commerce or payments.
Yeah.
I'm asking what can I get away with?
Yeah. Well, this is it requires a really detailed answer, I suppose. But maybe what do you want to get away with? I guess. You know, the thing is that, look, investors, especially people who do B2C, are used to being snowed, even more so than B2B investors, because there's just so much BS, and everybody claims, you know, half the population are users, and they're not. So the question is, if you're really credible, honest, conservative, do you get more value for it, or do you just show lower numbers? Everybody else. And also the market, as you know, has drifted from just sheer intake of users to actual engagement, you know, repeatability of it in a market which really doesn't encourage repeatability generally. So I think the answer, it probably gets packaged together with downstream conversion, engagement, et cetera, and what other tools or levers can get pulled. It's again a very vague answer, but I'd say be careful on what you can get away with, just because the vast majority of knowledgeable investors that's the first thing they assume is overblown. So probably overblow it if you can by 20 or 30%, but not by 100.
I mean, when you're talking to a more general population of investors, should you kind of overblow those numbers and then come, you know, go to closer conversations with you, kind of have a more detailed analysis of it? Or would that even turn away potential investors?
It's a very good question. There's probably a group of investors for whom sheer reach might have a perceived value. So you can show a much bigger number of literally, like people have touched our site, which is sort of like the magic of look how much we could potentially get to. For some people, they might be impressed with that as this points to evidence of, you know, much bigger future. Anybody who knows anything about it will say, well, let's just, you know, in and out. Or on balance, we generally are not playing for less knowledgeable investors, generally. We're generally playing, if you have to look at the spectrum, so the middle is sort of okay knowledgeable, most knowledgeable in the world, least knowledgeable in the world, we're probably playing over here. Yeah, you play over here and you're too careful and conservative, but you kind of need, and you know, a little over towards the more knowledgeable. At the end of the day, because we see that in terms of probability of converting to invest, generally people on that half are generally more likely. You will get the bluebirds. You will get the people who have no idea, and you can snow. And you know, if anything I say up here might even lead you to consider not to do that and you have the opportunity to do it, you've left money on the table because of something stupid I said, which is possible, by the way, certainly, believe me. But you're going to a mass audience, so you have to sort of, at least you have to pitch roughly where you're,
Or could you define it in a different way, like have, active users and then
You
real
could.
active users?
What you could do is you could version the deck and have a couple of extra slides that are universe slides, that show stuff you would never show somebody who's done 12 B2C deals. Maybe. And you might, oh, look, I wouldn't. Sometimes it can happen. Because, you can draw the African consumer thing and online, and you can draw GDP growth. I mean, you can do the numbers and all of a sudden get to, not only will the population be this demographic, but there'll be so much, you can do that. And somebody who doesn't necessarily know the execution problems getting from here to there might see, wow, I'm buying the African consumer access. You might. Look, and by the way, if you get, it sounds disparaging, if you get dumb money at a high price, and that's fine for you, I mean, far be it for me to suggest that, you try and be whiter than white or something about this, or, try and avoid it. But generally not. So maybe particularly after Jumia. Which, anyway, by the way, that's less relevant. Like when you're going to fintech, again, right, don't need to deal. That also becomes less relevant. Even people, it's very hard. You get journeyman investors, et cetera, but it becomes harder to screw around with the numbers. I say that even though digital banks in the UK have done that for the last few years and kind of gotten away with it, but the market's growing up.
What about using DocSend? Are those tools? I mean, they're frowned about from a lot of investors.
Oh, yeah, yeah.
It helps me as an entrepreneur.
Oh, yeah. The sort of, do I email a deck or not? This is subjective. It's a very fair question. Ordinarily, we would say just mail the deck, make it as frictionless as possible, and they're only going to look at it for 3 minutes, and if they have to click and yes, they know why they're doing it, but it's just one more thing. And just make sure that in that deck, there's nothing that, if it was out on the internet, you would have a problem with. There's the other mistake, by the way, forgetting DocSend or not, is that I was just talking to a new prospective client who's going to raise a pretty large round, and their last round 2 years ago, we got a copy of the deck. We didn't get a copy confidentially. Somebody sent it to us, okay, because we were just asking around. It was 105 slides. Not all to be presented, but they packaged the first 15 and everything else. We got it all. So I said, well, on page 71, you said this was going to be an important area, and it's not. Why? And that was insane. So I'm going to answer a different question, which is process. Normally, what we do is we'd say the 10 or 15 slides, assume the universe is going to look at it. Yep. However you do it. Then you normally would have a second, more detailed deck, which is an info pack, normally more financially oriented, but answers other questions. It normally front runs first set of questions you would have gotten from investors people are going to be asking. And that gets sent in that's maybe 20, 25 slides. And that's almost a commercial due diligence pack. That gets sent to people who have done a first meeting or call, probably done a second one and ask for it. Okay? Then that oftentimes gets packaged with a model. Sometimes it doesn't, but normally you package the two. That's for a subset of people who are serious. Right? And then there's nothing after that other than specific Q&A. And then it's due diligence. So staging it so that you just assume there's no confidentiality. And so you're limiting the circle of knowledge. DocSend versus not DocSend, again, my preference is reduce friction, but I understand why people argue it. On the basis, by the way.
Downstream, you can do DocSend.
Oh, yeah, of course. Oh, yeah. Yeah, we normally don't do it. By then, people have signed NDAs. Whether they're worth the paper and printed on or not is different. And most importantly, we've reduced the circle of knowledge. So, because you can screenshot DocSend.
Yeah, I find it useful for like what slide is really interesting for for investors what slide is not interesting, things like that.
Yeah.
It's not, I don't know, maybe it's not
Yeah,
that.
I understand. We generally not sometimes. We find that doesn't really help that much because
Yeah,
actually
yeah.
when they get the financial info pack and the info pack, at that point what they want is the model, and really what that is almost a walkthrough of the model, almost. So it's almost an aide memoir.
Yeah, yeah.
So in a way, whether they go through it a little or a lot depends on how they operate. So, and then that gets into, you know, exactly what is in the model and level of detail, and that's a whole nother discussion. But that's, and that, a lot of the metrics discussions we talked about, but, you know, the model can, what's in the model, the assumptions can move value 20, 30%. So even if you have an idea of value to begin with. So there's a lot still to play for. As I said, the rest of it comes in due diligence. So, and in between, there's a set of questions. So for example, for one company, we wrote a whole paper on sales efficiency because we already becoming an issue. For another company, we did a whole thing on customer definition in different categories and whatnot, that kind of thing, so that it's sort of 3, 4, 5 pages that answers those questions, almost an FAQ. So that normally has worked.
So, and also one other thing, when so investors really look through the slides pretty quickly. Sometimes they spend
3 minutes and 10 seconds on average, apparently.
Or even lower, right? So should you make the first few slides like not about the market, but just like, hey, this is how much money we make. This is our
Yeah, well, this is, yes.
this is why you should look at us.
Yeah, so that formulaic thing of the market, the problem, et cetera, starts to break down at Series C. Kind of, I know the market and I know the problem. Now, so you could probably, where you might do 3 or 4 slides on that, you probably do 1.
But I'm saying more of like the more impactful slides
Yeah,
at the beginning.
yeah,
rather than-
sorry, yes. And then I'm getting to is the more impactful slides is we are doing really well,
Okay, yeah.
right? Is in like slide 2, or maybe even slide 1.
Yeah.
And because they're buying the company, not the opportunity at that stage. Let's put it this way, they're buying company first, then opportunity second, or maybe even they already know it. The education of the opportunity needs to be built in, but it is not classically, doesn't have to classically be market, problem definition, our solution, and then how we're doing. That stuff's Series A. By the time we get to Series C, it's a lot less relevant.
Yeah, yeah.
So, yeah, so you answer your question is hit them earlier on with the we're doing really well,
Right, right.
and we're executing, because what they're asking themselves, it's a different kind of question. They're not saying, you know, if they win, I'll get a 10 or 20x out of this. They're saying, I want to feel confident, just add water, I get a 3x. Keep adding a little more water, I get a 4x. In, out, levers are clear, you know, I know what these guys are doing. So it's a passenger on a bus kind of metaphor. Whereas, of course, if you're at Series A, you're talking about this is where we're going after because we can build a very big company. At Series C, I don't care if you're going to build a big company. I really don't care. I just care about getting 3.5 times my money. You care about building a big company. Good luck. It's fine for me. I never get a 10x. So, and I want to never lose my money. That's what I'm interested in. That's my mentality. So I don't really care about the big opportunity, really, by the way. That's the dirty little secret.
Unless there are there other general questions? If not, I'll suggest that maybe, first of all, I think you guys already said thank you.
Fine. It's fine, I got it, yeah. Thank you. Yeah, thank you, but listen, your time is more valuable than mine, so thank you.
Hopefully everyone found it interesting, insightful, valuable, and Cal will send out some feedback forms electronically afterwards. But Victor has also kindly said that he'll hang around for another hour or so if you want to sit down one-on-one.
Yep.
And we're going to situate him very nicely in not this store, but the one next to it. So if anyone wants to go in one-on-one.
Yeah, don't feel you need to because I have other things to do. But but I'm happy to. The other thing. Well, the thing to do would be if you can send me everybody's email, right? And then what I'll do is I'll email you all with the presentation slides, and then happy if you want to respond back and ask any questions or talk about anything or whatever. Happy to do it that way, and it's it's just a private thing, so no problem there. But also, anything that comes to mind, I'm here.